Guys, today what I wanted to do was share with you my AI thesis. So I just wanted to be like 100% transparent, share with you my thought process on how I'm approaching the market now. What has been my thinking over the last couple of years to get these pretty damn good results on eToro. So this year we're up 15%, going pretty damn nicely. It's only the middle of February. So being a pretty beautiful year. 2024, 52%, and the year before that, 24%. So overall, everything is going quite nicely. So I just want to share with you my thesis. I think there is 3 stages of this AI thesis. I think stage 1 is kind of like truly already done. Stage 2 is like you're in the middle of stage 2, but now we can start positioning ourselves for stage 3. And so that's what I want to be really focusing on and explaining all of that, and getting prepared for stage 3. So you can potentially, if it turns out the thesis is correct, you can potentially profit from it as well. But so far, stage 1 being dead on, stage 2 pretty much dead on. I'm pretty confident that we're going to get 3 home runs in a row. But who knows? Always the market is the market. The market is what is always right. Us investors, we cannot predict the future. There's no guarantees when it comes to this stuff. So what I want to start off is just looking at the S&P 500. So the thesis kind of starts, I was thinking during 2022 when the market is pulling back hard, my thought process was, hey, everything in the market is pulling back. Eventually it's going to reverse, but when the market does reverse and everything starts moving up, you want to be positioned in the best trend, right? Because the saying is a rising tide will lift all of the boats. So the tide is like, the water. That's the market. That's the trend. It will lift up all of the boats, and the boats are the companies. So even the worst companies in a strong trend, like a company can be losing millions and millions and millions of dollars, but if the trend is right, the price of the asset will still go up, actually, because at the end of the day, it is supply versus demand of investors. If more investors buy the stock than sell the stock, price goes up. So it's a lot safer. It's safer to be investing in a rising tide, but not only is it safer, you can make even more money faster. So during 2022, and this goes for like every year, you want to be forward predicting or thinking, what is everyone else going to be doing with their money a year from now, or 2 years from now, or 3 years from now? You got to be ahead of that. So, you got to be thinking like a chess player, like thinking 2 to 3 moves ahead of everyone else. So during 2022, that was my thought process. What trend is going to be the big winner? And I am confident in investing in that trend because I actually understand it, right? There's a million trends, well, not a million, but there's a lot of trends, right? There's trends that I don't even know about that are happening in the world today, right? I literally don't even know. There's probably 4 or 5 big trends that, are making more money than these AI stocks, but I got no idea about them, right? So, um, don't want to mess up the chart here. During 2022, I was thinking, hey, market's going down. What trends do I want to be invested in? What technology do I think is going to change the world, or what industry do I think is going to change the world and make a lot of money? I wanted to be focusing on AI because, you know, in that stage, you just compare AI to every other industry. Like I had a lot of people saying, load up the crypto, load up the crypto. Crypto is cheap. It was, but how much can crypto change the world compared to AI? If the world is running off this super artificial intelligence, and there's all these robots and all this stuff, you can really clearly envision it. Where with crypto is like, how many winners in crypto are there actually going to be? And is it only Bitcoin? Is it only Ethereum? Is it only Solana? Like, is Solana even going to be a winner? I got no idea. But with AI, I can very clearly see the future and where it is going. I don't know exactly, but I thought it made a lot of sense. So I wanted to position myself for the AI trend. And that's not, look, in hindsight, it looks really easy, right? In hindsight, it looks really easy. Who was loading up on AI stocks? Yeah, all right. Very few people We're loading up on AI stocks. You can go back to my eToro. You can go into my profile and click articles. I'm calling the bottom of the market. I'm calling the change in the trend. I've got an article saying that AI is going to be the next bubble, right? And you actually want to be invested in a bubble because that's where you make the money as fast as possible. I've got a lot of evidence out there, and I've got many things wrong as well. But that's the beauty of eToro. Everything's 100% transparent, and that's what I want to do here with YouTube. I just want to share with you and document the journey because sometimes I'm going to be wrong. So I honestly believe about 30% of the time I should be actually wrong. My hit rate should be about 70%, 60 to 70%. So that means I should be wrong 30 to 40% of the time. But when I am right, I should win pretty damn big. When I am wrong, I should lose quite a small amount of money. So my thesis here was, all right, AI is going to be the trend that I understand and I think has a massive, massive potential. Then I wanted to break down that trend into 3 different stages. So first stage, I thought, usually investors understand, or the way they think is, the safest bet in a new trend is to invest in the infrastructure of the trend. Like you need the infrastructure. Like imagine you want to transport something from A to B. You need a road, right? Without the road, it's going to be pretty damn hard. So the roads are actually quite valuable, right? So you want to find the infrastructure that can capture the value. So these are the picks and the shovels. So when you're talking about the gold rush, everybody was trying to find the gold. Not many people actually got rich from the gold. There was very few. But the people that were selling the picks and the shovels, those were the business people that made a lot of money. So what was the picks and shovels, right? It's the obvious trade of AI, and it is the semiconductors. So the computer chips, like all this stuff, all this technology, AI, all of that, it runs off these computer chips. So that's how you get to NVIDIA. So stage 1 is the picks and the shovels. Stage 1 is picks and shovels. That's how you get to NVIDIA. I thought there's going to be more winners than that, right? And I thought I thought it was going to be it was going to move differently to how it did. So SOX here, that's an ETF, a semiconductor ETF. So it's like the S&P 500. It's a bucket of all of these investments in the space, but instead it's in the space of the semiconductors. The S&P is the overall market. It hasn't really moved the way I thought it would have moved. I thought it would have cranked a lot harder by now. So the bucket itself hasn't cranked as hard as I thought it would. It turns out that NVIDIA was the main winner up until today. There hasn't really been I thought it would have been the whole industry would have moved a lot harder. But luckily, what we're seeing right now is we've seen the move. We're consolidating at the highs. I believe the move is higher like that. So I believe SOX over the next 2 to 3 years should be approaching that $500 mark, a nice little double from here. So that was my thesis. I thought the picks and shovels, I spread my bets across the picks and shovels. I actually invested in SOX itself. You can see on the eToro portfolio, just search up my name, Dylan Weston, and you can see everything in the portfolio. So that was actually a decent sized position, SOX. But it turned out it was mainly NVIDIA, and I didn't have enough. The allocation in NVIDIA was a little bit too small. Not to how I thought it was going to play out, but at least we had a little bit in there, so we captured a decent amount of the move. But it's going to be interesting to see how SOX plays out over the next few years from here. Let's see, is it going to be NVIDIA that just keeps sucking in all of the value, or is it actually going to spread across some of the other companies in the space? So for now, I'm just, I'm thinking just keep holding SOX. But yeah, who knows? Time will tell. So that's stage 1 of the thesis. I kind of got it somewhat right. I captured it a little bit, but honestly, the execution could have been better. Could have loaded up a lot more on NVIDIA. Like the allocation size in NVIDIA just wasn't that large. So if we go check it out in the portfolio, scroll down to NVIDIA, here it is here. So it's only a 1.83% allocation. So 1.83% of my money was in NVIDIA and went up 435%. Where what I wanted to do was with SOX, where is it? SOX L. So this is a triple leverage, highly um, risky, right? It moves highly volatile, it moves like crazy. You can see I put a bigger allocation here, 3.6. So my mindset was, all right, it's highly leveraged, which increases the risk, but it's leveraged on an index of an industry, which is the semis, which I believe is going to be a rising tide. So the leverage, combined with the leverage is more risky, but combined with the index, the diversification, that's safe. Combine those two together, you wrap it up into a package, and it's actually not risky, right? I believe it's actually safe. But then look, 3.6%, only up 36%. It hasn't even been a good move. Like it hasn't, it's been pretty damn average. It's kind of been like our luxury goods, like Christian Dior, that's a minus. Um, so it's kind of like my luxury goods thesis. It wasn't, didn't go to plan as I expected, right? So anyway, that's stage one. Stage one is the picks and shovels. That's what I thought the investors will be thinking. It's the obvious move. The second phase, the second phase, I was thinking, all right, so after the picks and shovels move, what's going to move next? I think it is going to be the software-based AI companies, right? Why software-based? Because all investors have gotten used to software, software, software. What is it? You can replicate software and scale it across the world extremely quickly. There's no replication cost. So that means the profit margins are monstrous. So it makes a lot of sense, right? So that's why I think you get the open AIs and all of that. You get these companies moving really, really quick. Another software-based company is Palantir. So, Palantir, that execution was pretty damn spot on. I increased it to the second largest position in the portfolio and it's up 382%. So I invested 7.67% of my capital and it's up 382%. And last year, for all of last year, it was the number one investment in the portfolio. It's only been the last few months where I've increased it, microstrategy, and put it above Palantir. So from here moving forward, I believe microstrategy hopefully should be able to outpace Palantir. Let's see. Again, only time will tell, and it could turn out to be wrong again. But you know, based on how the portfolio is constructed, based on these numbers here, so you can see like what I'm thinking and where my conviction is. So I'm still confident with Palantir here, right? I've been wrong with Louis Vuitton, but from this moment in time, I'm still very, very confident with Louis Vuitton, and so yeah. How you construct your portfolio needs to be based on your conviction levels. So that was stage two. So stage two, I believe, is already played out. 382%. That's played out. It's definitely played out. You could even argue to trim the position here and take some profits off the table. I'm going to just keep on holding. My mindset is I'm going to keep on holding. I believe there's still room to run even further. So that's stage two. Now that kind of gets us to stage three. So if stage one's the picks and the shovels, stage two is the software-based companies. What is stage three? Stage three, I believe, is the opposite. It's the hardware, it's the physical companies. So what are physical? Like what is physical AI? We're talking robotics, we're talking automation with physical things. So what's a great example with that? Like something that's really easy to understand is something like Amazon, right? Amazon, all of their warehouses, they're automated by robots. Robots, they're super efficient. They got these little vacuum cleaner looking things. They can pick up a whole stack of shelves on their little backs. They got that strong back, right? They're little Hercules, little fellas. These guys, they work 24/7. You barely need to pay them an hourly rate. The hourly rate is, just the electricity and the maintenance costs. And, these guys, they're working 24/7. They're working their ass off. And, Amazon has gotten to the stage where, last time I checked, there was a graph like this of how many how many staff Amazon was hiring compared to, and it was just going up, right? It's just going up. The amount of people Amazon was hiring just going up insane. But then there was another that was overlaid with how many robots are they implementing. And so the staff was going up like in a linear fashion, but the amount of robots was kicking in like that, and it was going exponential, and it had already crossed over in COVID. So I believe that was the major inflection point. During the COVID time, they had more robots than they did humans. Okay. And then what is the trade, right? I believe, especially in the Biden era, where it's everyone was, their mindset was a little bit soft, to be honest. Um, and people were kind of anti-company, anti-profit, anti-capitalism, in a sense. You kind of had to keep on hiring more and more people. But I believe their cards is, if the robot trend is going up like this and it's going up exponentially, right? Follow the money. Follow the money. The money's getting invested in the robots. Eventually, I believe they actually chop the people here. So depending on the environment, politically, you want it to be so, because like it is quite scary with all of this AI stuff, with these robots and all of that. You got to keep the public on your side, and you got to wait for the right timing. But eventually, I don't know if hiring staff always goes up in an uptrend. I've got a feeling eventually starts coming down, and people you know, start losing their jobs over this stuff. People are going to they're going to try not to talk about it so much now. But that is the trade. That is the arbitrage, because the people are not as efficient as the robots. And the people, what happens? Like, they cost money. It's a labor cost, right? So if you think about a restaurant, everybody's very familiar with, like, what's one of the most expensive costs in a restaurant is labor. It's the people, right? And labor can cost around 20 to 30%, even more if it's not a very successful restaurant. um but people don't really think about what's the labor cost or what's the wages of an actual technology company. They're not really thinking about that. And in the restaurant field, like, it's possible, like, you go to a restaurant, and I do this. I've done, think about this all the time with Headstart Capital, as the founder of Headstart Capital, where we invest in hospitality businesses in Indonesia. um as an example, like, someone's labor costs could be 30%, and then if you can make it more efficient and get it down to 20%, right? You've created a gap here, right? And that gap is pure profit to the bottom line. So let's just say you got a 10% profit margin at 30% labor cost, right? So 10% is profit. Now, if you can get the labor costs and reduce it to 20%, you've increased the profit margin by a further 10%, which is actually double. So the profit margin's gone from 10% to 20% in total, right? You've doubled the bottom line. You've doubled the profit. Um, so that is the value of reducing your labor cost. So I think that's what's coming. I think that is what is coming with Amazon. But you save on the bottom line with cutting the labor cost. But what people don't realize is you can now handle more demand as well. Like, if you got robots cranking for you, you can actually increase your upside. You can actually increase your revenue. You can actually increase your top line. You have that capability then. Um, so it's a pretty wild thought. Another thing is, like, what I like to think about is, like, there's the robots in the warehouses, but then you can make robots to make the robots. You can make robots to maintain the robots. You make robots for everything, right? That's the point. Um, and if these little robots are on wheels, what I like to think about is, like, look at Boston Dynamics. If you go type in Boston Dynamics, type in, like, walking robot evolution. Um, and you can see how it has kind of evolved over the last 20 years or so. Like, the robot could barely walk. Now, it got to a stage where it could walk. It got to a stage where it could start to run and jump and do all these different things, and it looks like a human now, right? When it walks and all that. There's videos of people kicking it and stuff like that, and a part of me feels sorry for the robot. I got to remember, hey, it's a robot. But I heard this thing from Elon Musk, and he's just like, like, what's stopping these robots? Soon they're going to be running faster than Usain Bolt. He's going to be one of the fastest runners in the world. Why can't they run double that speed? Why can't they run triple? Like, what is actually the limit? I believe the limit, it can keep on going for, like, where is it? Is it the speed of light? Who knows? Um, and then you've got the constraint, like it's got legs. Are legs even good, man? Do you actually want legs, or do you want the little vacuum cleaner things like in Amazon, just wheels? So then, if we're talking wheels, all right, what's that correlated with? Where does our mind go there? It goes to cars, man. So, what is the constraint, or like how fast can these things go? They can go a lot faster than a humanoid robot looking thing. If they're wheels, they could be zapping around real quick, like 200 kilometers an hour, 300 kilometers an hour. So I think eventually these, in the Amazon warehouse, I wouldn't be surprised if the robots in the future going 100K an hour. It sounds crazy, but I think you eventually get there. Or there could be something that's, invented or in the future that's even better. So yeah, I think that's where technology can go, and that's why it pays to be an optimist as an investor. Like this stuff, it just goes so fast. Like what's happening with AI today is it's moving so quickly. It's moving so fast that I'm actually getting scared. Like I'm thinking as a very, I think I'm a smart guy. I think I'm quite intelligent. I'm scared, right? I am actually scared of where the world is going. It's really hard to keep up. And luckily, I believe this is the profession. Understanding where the world is going and then placing your capital accordingly so you capture that. So that's why with all of this AI stuff, I believe it's one of the fastest ways to make money. But at the same time, it is insurance where you can potentially get paid. Normally when you buy a health insurance or whatever, um, you have to pay and then you don't really get to cash out until, that negative thing happens. But you're paying, you're funneling your money out. You're actually getting opportunity costed. Whereas with this, it's insurance, because you're hedging your life, you're hedging your finances, you're hedging your job. Who knows if you might get made redundant in the future. You might not need your job in the future. And then imagine that. Imagine that. It's major, major risk. Like if you have all your money just in a property and then you're working in a job which can be replaced and in an industry that the whole industry can get replaced, like that's really, really, really risky in my opinion. Like, and you can go talk to your financial advisor and all of that, but I'm sorry, the financial advisor, a lot of the time, unless they're really switched on, they're not thinking with an investor mindset. And it's different. It's different now. It's really, really different now because technology is just going too fast. There's no way you can study, become a financial advisor 20 years ago and know what's happening in the world, in the investment world, unless it is your job to know what's going on. And, it's kind of like, I'd rather see a guy who's an investor first, and then on the side, he's a financial advisor. I would like to see that. If they're just 100% financial advisor, I don't know. Odds are, if you got 100 financial advisors, they can give some good financial advice based on the present, but I don't know based on the future. I think things going to get a little bit weird with this tech stuff. So that's my advice. I'll bring that up to a financial advisor and test them. Right? What's their thoughts on AI? How much percentage allocation of your portfolio of your net worth should be invested in AI? I think it's not only a thing to maximize money, it is insurance. All right. That's how I'm personally thinking about it. Um, yeah, I'm curious. Do you guys actually agree with that? Do you disagree with that? Post a comment below. I'd love to hear it. So yeah, that's kind of like my three stages of the AI trend. Amazon has already started, but overall it's in this lower band here. It's in the lower band. So if we zoom out, it's under the white line. That means it's actually quite cheap at the moment. Because if we look at the history of Amazon, how often has it been below the white line? So there's one actually back here at the start of the IPO, boom, boom, little bit here, tiny little bit here, all of this, all of this. Amazon has been out of favor for the longest time recently. Recently meaning now. I doubt you get this again in the future, right? Most of the time, Amazon is above the white line 95% of the time, probably. 90 to 95% of the time is above the white line. I believe it's getting back above the white line. and everybody's going to be looking back at today, and it's going to be obvious, mate. Amazon's going to have all these robots. Everybody's going to talk about it. It's going to be the obvious thing in hindsight, but no one is positioned for it. Check the eToro. The eToro is already ready to go 4.6%. We've got some index funds as well, which is holding a lot of Amazon. We're loaded up. We're fully loaded, fully ready to go. So that's my thing. That's what I'm thinking right now. The third stage of the AI trend is robotics. There's more companies in here that are doing robotics, but I just wanted to focus on Amazon today because it is easy to understand. But I highly, highly recommend going on YouTube. If you're not familiar with what Amazon is doing with robotics, just type it in Amazon robotics, robots, and just educate yourself. Everything's based on self-education. And then if you understand the companies, understand where they're going, you're going to build conviction, you're going to build trust. And then you're really going to be able to invest with significant size. You don't want to just chuck $100 in Amazon. I think you're going to get rich. You're never going to make money. You're never going to make a life-changing amount of money with just $100. You want to self-educate so that you build your confidence that you can go in big. Because big money that's actually how you make the bigger money, right? And then when the market pulls back, because it will, the market zigs and zags. Look at Amazon. Zigs and zags like crazy. Every single stock in the world does that. The only assets that don't do that, it's kind of like, or the only vehicles is like kind of like a savings account in a bank. But that's why you get paid nothing, because you don't have to have, you don't have to go through any of these emotions. We get paid for going through this roller coaster ride, right? That's what it's about. If it's nice, how it's going to be cruising down the lazy river, right? The lazy river, it doesn't scare you, so you don't get paid. You get scared. The more scared you get, kind of, the more you get paid. All right. So that's what we're looking for. We're looking for these volatile. They're volatile, but remember, there's a difference between volatility and risk. Risk means they go down, they never come back again. You lose your money forever. Volatility just means, hey, it's a bit of a bumpy journey. That's it. All right. So I think that's pretty much everything with this. Again, if you've got any questions, you know what to do. Post down below. If you made it this far, please give me a like. It really helps out a lot. Any feedback, I'd love to hear it as well. Thank you very much, guys. Have an absolute ripper.